Imagine this. Your small business is absolutely crushing it. Sales are skyrocketing, momentum is unstoppable. But here's the frustrating reality that's holding you back. Borrowing costs feel glued in place, and traditional banks are turning down good businesses faster than ever. At the same time, AI-powered lenders are exploding with approvals, handing out more deals than anyone expected. What's really going on? It all traces back to the Federal Reserve's latest power moves. In this video, we're breaking down the absolute freshest 2026 data on how Fed policy shifts are completely reshaping small and medium business lending, and why AI credit models have become the ultimate game changer for everyday Main Street entrepreneurs like you. These insights could literally save you serious time and money. Let's get started. Fed policy shifts, the 2025-2026 reality. By early 2026, the Fed has held the federal funds rate steady at 3.5% to 3.75% for the second straight meeting. That's the March 18, 2026 decision. After three 25 basis point cuts in late 2025, policymakers hit pause.
Inflation remains somewhat elevated, economic activity is solid, and the labor market is stable but soft. The latest dot plot still calls for just one rate cut in 2026, taking the median rate to around 3.4% by year-end. Prime rate locked at 6.75% as of April 2026. That directly feeds into everything from SBA loans to commercial lines of credit.
NFIB data from February 2026 paints a similar picture. A net 5% of owners said loans were harder to get, close to historical averages, while interest rate complaints eased slightly. SBA numbers tell a brighter story. In fiscal year 2025, the agency guaranteed a record $45 billion across 85,000 7A and 504 loans, the highest volume in the program's 72-year history. Average SBA 7A rates in Q1 2026 hovered around 9.79%, tied to that 6.75% prime. Bottom line, higher for longer rates from 2022 to 2024 tightened credit standards and slowed lending. The 2025 to 2026 pause has stabilized the market, but access remains uneven, especially for riskier or newer SMBs. The AI credit revolution. Why it matters now. Enter AI credit models, the silent disruptor. Traditional lenders rely on FICO scores and collateral. AI platforms analyze thousands of alternative data points in real time, cash flow volatility, supplier payments, even industry trends. Result? Dramatically better outcomes. Lenders using AI have cut origination costs by up to 14%, reduced defect rates by 40%, and shortened loan cycles by 5 days. Some platforms are approving 25% more borrowers while keeping default rates lower than traditional models. In a high-rate environment, AI doesn't just react, it adapts. Research on AI-powered lenders shows they maintain consistent credit standards through economic cycles, unlike banks that tighten sharply when the Fed hikes. For SMBs, this is huge. No more thin file rejections. Online and alternative lenders using AI posted approval rates of 68.5% in early 2026 versus just 21% at large banks. The intersection. How Fed policy is reshaping AI models for SMBs. Models now stress test for higher for longer scenarios automatically. Fintechs using MLOps, or machine learning operations, refresh models quarterly instead of yearly, staying ahead of policy changes. The payoff for SMBs? More inclusive lending. AI is filling the gap left by cautious banks, powering record SBA volumes and helping mid-market businesses scale, even when traditional credit tightens.
Looking ahead, if the Fed delivers that one expected cut in 2026, borrowing costs could ease further, supercharging both bank and AI-driven SMB lending. But even without it, AI is making credit more accessible and resilient than ever. The takeaway? In 2026, smart SMB owners aren't just watching the Fed, they're leveraging AI-powered lenders to stay ahead. If you found this breakdown useful, hit like, subscribe, and turn on notifications.